after 419 days of the highest interest rates we've seen in the last 2 decades and 916 days after starting the fastest rate hiking cycle in American history. Interest rates were just cut by 50 basis points on Wednesday, the higher end of expectations. Now, as of the end of the prior week, expectations did suddenly flip to, an enhanced probability of 50 basis points odds. Welcome back to another edition of the 𝗟𝗟𝗡𝗚𝗏s Daily Podcast of the Day. Thank you all for joining us here once again on this beautiful Wednesday, September 18th, 2024. My name is David. Great to have you guys here with us because this was the big one. It was a big day today in markets, and I think everybody here knows why. The Federal Reserve has finally gone ahead with their interest rate cuts. This is something that we've been looking forward to for basically the last year or so now, and they finally did it. So the big question in everybody's minds now becomes, well, what next? This was the big thing that everybody was planning around, everybody was trading for. So what happens going forward? Well, stick around for the next couple of minutes and we will be sure to tell you in all the detail that you want. We're also going to be diving deep into some additional economic data that came out here today, specifically related to the housing market and how much supply is growing, what that means for housing affordability going forward. And of course, we got some big stock movers of the day, some more interesting names that we might be a little bit less familiar with, but definitely not less interesting stories going on. So before we go ahead and dive into all that, let's take care of some of the high-level stuff here today. The WSO Alpha portfolio, our proprietary investment portfolio, which you can all trade along with us at the Wall Street Oasis /Alpha, I believe is what it is, maybe /WSO Alpha. But if you Google WSO Alpha, you'll almost definitely be able to find it. And I'm sure that you're going to want to after the insane outperformance that we've registered here today. So on the day, the NASDAQ portfolio, the NASDAQ index, down 31 basis points for the session. The S&P 500 down 29 basis points. Very strange considering that a rate cut just came in, but the WSO Alpha portfolio was down just a cute little 4 basis points, so relatively resilient day compared to the indices. Meanwhile, small cap stocks this makes sense. Small cap stocks, the Russell 2000 was up 2 basis points on the day. That's generally, in line with what we'd expect on the day of a rate cut because small cap stocks tend to get worse credit ratings. So when there is going to be a rate cut, it's going to have more of a kind of multiplicative effect on those because they're starting from a higher point, so they're going to be pulled down a little bit further. Their interest costs become a little bit more manageable, so it makes sense to see more of a reaction on the small cap side. Year to date, the Alpha portfolio is up 11.48%, still woefully underperforming basically every single important index that's out there, but trust me on this one, we just got to trust the process here. Longer term, Alpha portfolio kills it. If you take any kind of 10-month period besides the last 10 months, we probably outperform. But that's the luck of the draw. They want to make it nice and difficult on us. Guess this is what they mean when they say God gives his toughest battles to his strongest soldiers. Obviously, this is what they were referring to. So, rough day in markets, or basically an overall flat day, despite the fact that the Fed was cutting. A lot of that was priced in already, and that's what I mean when I say everybody is wondering what's next at this point. We'll get into that in a second. Before we do, some banana bits to go through first and foremost. Absolutely, everybody should check out this first banana bit link right here because this is one of my favorite, I don't know if it's an economic indicator or more of an economic tool, but it's one of my absolute favorite resources out there. It's the Fed Statement Tracker from the Wall Street Journal. You don't even need a subscription to access this thing, so everybody click on that because what it shows you is the differences between the last Fed statement and the current Fed statement. There were a ton of changes at this one. Basically the first time any kind of material changes have come into play for the last 3-4 years at this point, so definitely go ahead and check that out. Meanwhile, at the same time, we found out yesterday that U.S. steel is going to be remaining U.S. and most notably not being sold to Nippon Steel in Japan until at least after the November election. Speaking of the November election, we could all learn a little something from the Teamsters Union. Now, the Teamsters Union, this is I believe it's like delivery drivers, kind of like couriers. I don't know why they're called Teamsters, but I'm sure that's great for employee morale or something. They came out here and said, fuck it, we're not endorsing anybody, and I respect the hell out of that. That is my favorite political take of the entire year. We are not doing anything. We're going to shut up, stay in our lane, and just focus on delivering packages. Absolutely love to see it. Meanwhile, Salesforce's artificial intelligence strategy is getting hot. Analysts are absolutely loving it with this agent force idea. Really cool idea. We're probably going to spend a thought banana talking about it relatively soon, but, not really going to go into it right now. Finally, maybe the United States, we might not be in as much of a savings glut as we think. It turns out that total net national savings are actually negative and have been so since the first quarter of 2023. This is factoring in government as well as corporations in addition to individuals, and it's kind of weighing them against foreign investment as well. And it's really foreign investment that is keeping us afloat, but it just shows how bad everybody wants a little slice of the United States. And we can talk about exactly why now, because now we are going into our big macro story of the day. This one is titled, What's Next? Because that's at the forefront of everybody's mind going into Thursday after the Fed has finally initiated its interest rate cutting cycle. Many of you have probably seen the movie Dodgeball, and because of that, I'm sure many of you have subscriptions to ESPN 𝗟𝗡𝗚𝗚𝗏, where they show events that are bigger than the World Cup, World Series, and World War II combined. Phenomenal movie. If you haven't seen it, definitely go and check that out. But what the Federal Reserve did today was just that big as well. Our hero, Federal Reserve Chairman Jay Powell, became Mr. J Pump once again. And then he opened his mouth and it all kind of fell apart. So let's talk about exactly what happened. There are certain things of beauty in this world that can't really be described. And I think if you look at a chart of the Fed funds target range, especially after yesterday, that is absolutely one of there. It's up there with the damn Mona Lisa, if you ask me, because what you're seeing is gradual steps higher, flat for quite a long time at that 5.25 to 5.5% range, and then bang, shooting right down to a range of 4.75 to 5%. That's right, apes, after 419 days of the highest interest rates we've seen in the last 2 decades and 916 days after starting the fastest rate hiking cycle in American history. Interest rates were just cut by 50 basis points on Wednesday, the higher end of expectations. Now, as of the end of the prior week, expectations did suddenly flip to, an enhanced probability of 50 basis points odds. That became the majority opinion from markets at kind of the drop of a hat. There wasn't really the aggregated economic data is kind of what pushed it over the hill, but it wasn't like one piece of anything that drove that. Nonetheless, the Federal Reserve did cut by 50 basis points. As recently as back in July, Powell was out there saying at the Fed's press conference after the July meeting, he said, quote, "We are not actively considering 50 basis points at this time." Well, a lot has changed since then. Most notably, employment has kind of started to fall apart a little bit. I don't know if fall apart isn't necessarily the right term. I'm kind of talking out of my ass there. It's really the unemployment rate is the bigger concern going forward than inflation. So that means we're going to have to start getting into a bit of a loosening cycle rather than the tightening that we do to quell inflationary pressures. Now, one of the interesting things about this 50 basis point cut is it is the first time since 2005 that a Federal Reserve Board governor has dissented from the majority decision. Now, couple things to note there. First of all, it's interesting that it's been 19 years since a Federal Reserve Board member has dissented from there. I know Thomas Honig very famously did back in the day when with Ben Bernanke, when they were kind of initiating QE and going into the GFC. That was probably the last time that a Fed governor actually dissented. But Miss Michelle Bowman, former Kansas City Fed, I believe, or something out in Kansas City. I don't know if she was the president of the Kansas City Fed or if it was something a little bit different out there, but she dissented, saying that she would prefer a 25 basis point cut. So pretty interesting to see there. It's probably not great to know that the central bank, the most important economic institution of the United States, goes entirely on unanimity. I mean, there should be some disagreement, right? Like there should be some conversation going on, like competition between ideas to ultimately come up with the best one. And if we're just agreeing on everything, it seems like we're all just sucking off the Fed chair effectively. So it's probably not the best way to manage an economy, but hey, I mean, it's, so far it's been working out. We'll see how it does going forward. A couple of quick key quotes to note from the press conference. So first and foremost, Powell was asked exactly why they were doing 50 basis points, if they were rushing, if the labor market was falling apart that badly, that they felt that they had to do 50 basis points. And Powell came back hitting hard. He said, "The labor market is in solid condition, and our intention with our policy move today is to keep it there. The U.S. economy is in good shape. We want to keep it there. That's what we're doing." He then went on to say, "We don't think we're behind. We think this is pretty timely, but I think you can take this as a sign of our commitment to not get behind." So I think that kind of tells us the worry in Jay Powell's head was that if they only did 25 basis points, it wouldn't be enough to help out on the employment side, and we would start to see unemployment tick higher than we otherwise would between now and the November Fed rate decision. So ultimately, this is them kind of trying to stay ahead of the curve. Everybody has been saying that the Fed is coming in too late, but certainly Jerome Powell does not think so. Now, pivoting over, when asked about the balance sheet, this is not the focus of the meeting at all here today, but there was some conversation. He said, We're not thinking about stopping the balance sheet runoff because of this at all. We know that these two things can happen side by side. In a sense, they're both a form of normalization, and so for a time, you can have the balance sheet shrinking but also be cutting rates. Now, you don't want to do this too long because you spur inflation, but at the point that we're at right now where, excluding shelter, inflation is well below the 2% line at this point, it seems like now is one of those time periods where you can get away with doing both of these loosening factors at the same time without re-triggering a huge uptick in inflation. Finally, another notable quote is the level of those conditions, and by those conditions he's referring to the labor market, the level of those conditions is actually pretty close to what I'd call maximum employment. So you're close to mandate, maybe at mandate on that. Did you hear what I just said there, Apes? Jay Powell came out, the chairman of the central bank, came out and said that we are at mandate. That basically means the U.S. economy is at equilibrium. Can't get better from here. So what does that mean? Well, that's a little bit concerning if the economy can't get better from here, and that is a big reason as to why you saw markets start to sell off in the aftermath of the decision. Because after turning into J pump and stocks going through the move immediately on the press release that the Fed was cutting by 50 basis points, stocks were higher from 2 to 230, and then after 230, we kind of slowly trended lower until the close at 4 o'clock. Thank the fucking Lord it closed at 4 because I can't imagine how much more it would have fallen by 5 o'clock. Nonetheless, the big reason for that is because in his Q&A session at this press conference, Powell was basically just saying, the U.S. is kind of in a great condition right now. If we're going to keep improving from here, we're going to be officially setting records. It's going to be nothing that we've ever seen before. So it's either something that's never happened before in economic history of the United States where we actually start to improve from equilibrium, or things are going to get a little bit rockier from here. Now, if we go ahead and take a look at some of the other materials that the Fed gave us with this meeting. Luckily, we don't have to speculate on what the Fed is thinking about going forward. At this meeting today, they dropped their latest summary of economic projections, or their SEP. This is a quarterly report that the Fed delivers alongside its FOMC meeting where they, make policy decisions for monetary policy. So they came out here and they basically tell us what their expectations are on rates, inflation, unemployment, and GDP growth going forward. There's a couple other things that they include in there, but this is the important stuff for our purposes here today. Most important, we got an updated dot plot, which is always a fantastic thing to see. Now, the dot plot is exactly what it sounds like. It's when the Federal Reserve board members use dots to show where they think the Fed funds range target is going to be at the end of any given year. So 2024, they're effectively saying that the Fed funds rate is going to close at around 4.5% towards the end of this year. That would imply roughly 1 or 2 more rounds of cutting, because now we're at 475 to 500 basis points. By the end of 2025, we're looking at about 3.3, 26 at about 3 flat, and 27 similar range at about 3.0%. Now, if you ask the market what their opinion is, they disagree heavily. They personally think that we're going to end 2024 more around 4%, according to the Atlanta Fed's tracker. So this is going to be an important thing for markets going forward, is how that gap closes. It's either going to be the market kind of acquiescing to the Federal Reserve and starting to shift their end-of-year rate expectations higher, or the Federal Reserve acquiescing to the market and saying, okay, you guys are pricing for lower rates, fine. We'll give you exactly what we were looking for, and we will go lower. Now, one of the important things about this dot plot that we definitely want to point out is the difference between the June summary of economic projections and the September summary of economic projections. Now, the dot plot was one huge difference. One of the biggest things that you notice is that in June, the dots are kind of spread out like this. In September, they're much more like this. They're still very variable, but much less variable than we were in June. So what does that tell us? First of all, increased certainty from the Federal Reserve's perspective on the path of rates forward. This is largely due to another thing that Jay Powell mentioned during his press conference. He said that by waiting so long to cut rates and seeing that inflation remained low, that gave them additional confidence in the path of rates going forward. So I guess being patient pays off sometimes. I can't say that that's ever happened in my life personally, but I guess on the economic side, it might be true. Now, interestingly, back in June, the lowest rate expectations that any governor was looking for at the end of 2024 was where we are right now. It was 4.75 to 5% range. Now, people are going as low as 4% to 4.25%. That was one board member who said that. 2 board members think there's going to be no more cutting for the remainder of the year, and everybody else is somewhere in between. So we will likely be ending this year, my guess is probably 4.25 to 4.5%. Probably somewhere within that range. I would expect 2 rounds of 25 basis point cuts going forward. But that's all going to depend. That could very well change with labor reports, with spending reports that come out between now and then. Now, with all of this in mind, before I go into some of the expectations for GDP, unemployment, and inflation going forward, keep in mind that as early as July, the Fed was saying we are not considering 50 basis points. So absolutely nothing they say is going to be true for more than the literal second that they're saying it, because anything can change on a dime. But when it comes to the unemployment picture, we are expecting higher unemployment by the end of this year. Now, that doesn't mean high unemployment. It just means slightly higher. So instead of the 4 to 4.1 unemployment rate range that we were expecting back in June, we are now looking at closer to 4.2 to 4.5%. That's kind of an even distribution of where the Fed board members are looking for right now. When it comes to PCE inflation, though, we're moving in the right direction. Somewhere between 2.1 and 2.2% is the overwhelming probabilities, but it could be up to as high as 2.8% according to these expectations. Finally, we have in terms of GDP growth, the expectations moved lower, but again became a little bit more certain in a range of about 2 to 2.1%, which for the US economy, kind of right where you want to be in that 2 to 2.5% range. It's healthy growth, but not too fast or anything. So overall, conditions in the U.S. economy are looking great right now. And so the reason that everybody's getting a little bit nervous is because when things are at their peak, where else do you have to go besides lower? Things could get a little bit rockier going forward, especially, as rates are cutting, there absolutely is a possibility for inflation to return. And the Fed outlined this in their summary of economic projections as well. For both employment and inflation, the risks are to the higher side. So as of right now, the current risks posed on the inflation and the unemployment side, according to the Federal Reserve Board governors, is more likely to take both of them higher than risks to take both of them lower. So again, we're not in kind of like a perfect position in terms of expectations going forward, but as of right now, let's enjoy it while it lasts, because the U.S. economy is firing on all cylinders and borrowing costs just became a little bit lower. Congratulations, you made it to the first Fed cut of this cycle. All right, let's go ahead and move on into some of our big stock movers of the day. First and foremost, we have Intuitive Machines. I got a question for everybody. How does a quick $4.82 billion sound? Would you mind? I got a little bit extra. I just can't carry it on myself. Would you hold my $4.82 billion for me? That is effectively what NASA just said to Intuitive Machines, ticker symbol LUNR. This is a stock that probably few and far between of you have actually heard of, but it is a company that develops lunar modules, other space-based technology, and the company just earned a huge contract from NASA. So that number, $4.82 billion, is the maximum value of a contract that Intuitive Machines just won from NASA in order to develop, quote, lunar data satellites. No idea what that means. I assume it means satellites that go around the moon and take pictures and amass some other forms of data or whatever. So that's my kind of guess as to what it is, but either way, the contract value of $4.82 billion is over a 5-year term, and that is only if certain targets are achieved. So Intuitive Machines today received $150 million, and that sent the stock up 38.33% by the close. It's also important to note that $4.82 billion is roughly 4 times the size of the company's market cap, even after a 38.33% rise. So this was not only a huge value add to the company in terms of their revenue, but it's just a proof of concept that they are a serious player in the industry and that the firm, in fact, has got game. So the market's going to be looking for more of this going forward. Moving on down below, we have VF Corp. This is the company behind some of the most hipster brands in the entire world. The shit that all the cool kids would wear back in middle school, like Vans, North Face, shit like that. They got a big upgrade yesterday from Barclays, and that sent the stock up 3.86%. Shares have been down about 1.3% year to date, and recent economic data has showed that consumer spending on apparel isn't necessarily slowing down as much as we may have expected. Now, it was a lousy back-to-school season, but at least the early data from September is showing relatively strong performance heading into the winter up here in the Northern Hemisphere. So, shares popped on that because Barclays said that the risk-reward is now more attractive. Great day for VF Corp. Moving on down into our stinky, rotten movies of the day, we have Open Door down 6.78%, and oh my god, it really does require a special kind of stupid in order to pull off this kind of a performance. Rates are cut, you would expect housing stocks to pop off, especially Open Door, because it's a damn good signal that housing demand is about to increase because borrowing costs got lower. So for the stock to fall 6.78% on the day, I'm honestly impressed at the level of stupidity that takes. Interim Chief Financial Officer Christina Schwartz paired up with Chief Legal Officer Sidney Schwab to both somehow not talk about this. I don't know how this wasn't communicated. They both decided to start dumping shares on Monday of this week. CFO Christina Schwartz sold 25.8 thousand shares, whereas Chief Legal Officer Sydney Schaub sold 77.4 thousand shares, both on Monday. I get it. Communication is hard, but it's so important to keeping a relationship and a company alive. And I don't know how the fuck they didn't talk about this, but very rough day for the firm, and the stock fell almost 7%. Finally, we have Casella Waste Systems. If anybody out there works at Casella and is listening to this, I got a bone to pick with you. I had to call into Casella 4 times in a single week when my dumpster. So we're doing a lot of work on the house. Like there's a lot of we did a bathroom renovation, we took down a wall, we're doing a whole bunch of other stuff. So we have had a lot of trash. Contrary to what many believe, I don't just want to live in a trash pile. So what did we do? I looked up dumpsters near me. Casella Waste Systems was one of the first that got up there. I saw that they had a stock, so I'm like, publicly traded company. They probably want to keep a good reputation. Called them, got the dumpster out there the next day, filled that shit up by the end of the weekend, and then I called them on Monday because the way the dumpsters work is you effectively get them for a certain period. Most of the time, they'll give you 10 days and you don't get any additional charges. Casella, they're a little bit more... They're a little bit more frugal with it. They don't want to give you 10 days. They give you 7 days in total. That's no problem for a dumpster filling expert like me. I actually do have years of experience doing that with my fucking dad going to different jobs like that, filling up dumpsters. If you guys need a dumpster filled, shoot me an email. Nonetheless, before we get too off topic, I got this dumpster filled up by Sunday, and I'm calling them on Monday to be like, hey, come pick your shit up because I don't want you to leave it here after Thursday and then start charging me extra. They're like, oh yeah, it's actually on the schedule to get picked up on Tuesday. I'm like, great. So I call them Wednesday because they didn't come. And they're like, yeah, it's on the schedule to get picked up today. Didn't show up, so I call them Thursday morning. They're like, yep, it's going to come before afternoon. All of a sudden, it's 2 o'clock and my dumpster is still sitting in my driveway. And so I call them and I'm like, what the fuck is going on? And while we're on the phone, the truck actually showed up. So maybe if this company could figure out how to turn around their dumpsters and increase turnover of their assets, they wouldn't need to raise $400 million by selling Class A shares and diluting the shit out of investors. Yet that is exactly what they announced yesterday. The stock was down 5.78% because the company is raising $400 million through an equity sale. Like I said, diluting investors. Obviously, they're not going to be too happy about that. So maybe just fucking pick up your dumpsters on time and you won't need to raise $400 million from the street and get absolutely humiliated on the day. Okay, let's go ahead and move into our thought banana final story of the day. We were talking about hyped up home builders. For some reason, Powell thinks he's cool out here. He's coming out, cutting interest rates, thinks he's fucking flexing on everybody. But for home builders, they've been there and done that. They are not surprised by this news whatsoever. Mortgage rates have been declining just about all year because everybody has been waiting for the Fed to start cutting rates. But yesterday, home builders were looking like a kid getting a Happy Meal, nonstop saying, I'm loving it. We got the new residential construction data from I actually don't know what the source of the information is, and I don't have it opened up here. I don't have it linked either, but it's whatever the official report is. I totally forget. I think it's the NAR, but I could be wrong on that. So anyway, national home builders. Basically, what are we talking about here today? Well, we're going over the numbers of permits, starts, and completions in the United States. Permits means municipality saying, yes, you can build a house here. Starts meaning you poured the concrete. You actually started to lay the foundation of the house. Completions means that knob and key, all it takes is to open up the door and you are good to go. So in terms of permits, on an annualized rate, August clocked in at 1.475 million units. That is up 4.91% monthly and down 6.53% annually. Starts annualized came in at 1.356 million, up 9.62% monthly and up 3.91% annually. Meanwhile, completions were putting up big numbers at 1.788 million annualized rate, up 9.22% since July and up 30.23% since August of last year. So we're doing a great job of completing these houses. If you go back roughly 9 months, the data is the exact opposite. Permits are looking particularly strong, whereas completions necessarily aren't. So the big question right now is this a longer term trend, or is this just kind of, like continuing to ping pong back and forth? Like we know that China won the gold medal in ping pong at the Paris Olympics in 2024, but really, if they had to go up against home builders, I don't think they would have had a chance because of how much ping ponging these growth rates have done. Just go ahead and take a look at this chart. Or maybe it's on this side. Take a look at this chart if you're watching on the video there too. Wherever Sachin wants to put my charts, just go ahead and take a look right there, because it's pretty interesting to see how it's literally just up, down, up, down, up, down. And this month happened to be an up one. Now, there is reason to believe that this is a stronger trend. First of all, if we go ahead and take a look at the data, even the up months, usually one either permit starts or completions are lower. They're moving negative for the most part. And last month, we saw all three increasing on an annual basis. So, overall, relatively strong, or on a monthly basis, excuse me. So overall, relatively strong improvements from there. Plus, the other thing is, I don't know if you heard, rates are going lower. And when rates go lower, that means increased mortgage demand because the cost of financing is easier to attain. So overall, relatively good news in the housing market. Now, 30-year fixed mortgages did sit at 6.78% going into August. They fell 6.3% throughout August to 6.35%. They moved even lower since then. So we only expect we basically only expect demand for mortgages to keep increasing. That should motivate home builders to keep building, but don't think that that's going to do anything to the affordability crisis. Even if these home builders do build enough homes, there's so much secular demand from developmentally delayed millennials as well as their Gen Z compatriots that are coming into their home buying years. There is so much demand for these houses that, no matter how many we build, realistically, it's probably not going to be enough, especially with the amount of immigration that's occurring in the United States. Expect home prices to remain, elevated and extremely unaffordable for at least the next year. Maybe that's just for the next year, at least the next decade, I mean. Maybe that's me just smoking pure copium because I want to make sure that my house retains its value because my entire life savings is in this and I got fucked over on the mortgage rate. But nonetheless, I don't cry myself to sleep about it or, constantly stress and have to go to the hospital over it on a relatively weekly basis. Definitely don't do any of that, but still don't expect home prices to get much more affordable. If you're considering buying right now, but you're saying, no, I want to wait until prices go down a little bit, shut up. Stop deluding yourself. It's not going to happen. Just go ahead and pull the trigger. All right, apes, that about does it for us here today. Thank you all for joining us once again on the WSO Daily Peels Daily Podcast of the Day. We always appreciate seeing you guys. We always appreciate your feedback. Thank you to those of you who send me emails and tell me what we can improve upon, what we can't improve upon, even if they're really mean. It's at least funny for me. It's something that I can, show my girlfriend or something and be like, look at how hysterical this is. They're calling me fucking retarded or something like that. So send me an email. Thoughtful emails will get thoughtful responses. David@WallStreetOasis.com. And I can't wait to see you guys in my inbox. Like, subscribe, boost our algorithm, make sure that I can keep my job. And if you do, I will see you guys tomorrow. Happy investing, happy trading, and bye now.